Let's answer the question. Is the gold stocks rally done? The rally hasn't started yet. Not even close. Are you convinced? There are dangers with gold mining stocks. There's the big taking question, the great taking question. If you believe that brokerages are going to go down, there are ways to get around that. You can buy mutual funds directly with investors that don't go through brokerages. There are other options. Talk to more conspiratorial preppers than me. But in general, just to remind you, the reason that I invest in some gold stocks, which are not as safe as bullion, but I do invest in some gold stocks, is because in the event of an endgame where the dollar cannot purchase anything, I want companies that can pay me actual dividends in product in money terms. And gold miners can do that because they create money itself.
In today's Precious Metals news recap, UBS says silver poised for all-time high as investors flock to precious metals. Silver prices have surged to $42 an ounce, a 14-year high on the back of record gold prices and a wave of investment inflows. Following the rally, UBS has raised its forecasts for the metal, saying it could reach all-time highs in the coming year. The bank now forecasts silver to trade at $44 an ounce by the end of 2025 and climb to $47 by mid-2026, aligning its outlook with a recent upgrade to gold. We flag that silver prices could reach an all-time high, a view that supports a long position in the metal or selling its downside risk for yield enhancement, strategists Dominic Schneider and Wayne Gordon said in a note. The rally comes despite sluggish global industrial activity, with investors drawn to silver by the same macro forces propelling gold. UBS pointed to geopolitical tensions, U.S. fiscal deficits, slower growth, and the prospect of Federal Reserve rate cuts as drivers of demand. Silver's strong correlation with gold, typically between 0.5 and 1, has amplified these effects. Exchange-traded fund inflows underline this trend. UBS highlights that silver-backed ETFs have added more than 20 million ounces this quarter alone, bringing this year's total close to 80 million ounces. While significant, holdings remain more than 200 million ounces below their pandemic-era peak in 2021. Looking ahead, strategists see silver benefiting further as monetary conditions ease and investors look ahead to a cyclical recovery. The team expects the gold-silver ratio to decline toward 80, supporting relative outperformance for silver. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
So the first thing I want to show you is a long-term chart of the BGMI. What's the BGMI? Well, it's the oldest gold mining index that I could find on Gold Charts R Us. It stands for the Barron Gold Mining Index. BGMI goes back all the way to, I think, the 19th century, but this is what you want to see right now. This is the gold mining index of various gold stocks going back many, many decades, and you can see here we are at very near all-time highs. Look at that. Look at this rally. These are, I think, yearly candles. So yearly candle, we are in the best year nominally for gold stocks ever. I think this is the longest candle ever so far, and we're only in September, so we have a while to go. This could very well be the longest positive yearly candle ever for the Barron Gold Mining Index. So on this chart, if we just look at it nominally, it looks like, wow, the gold miners are really roaring. They're really popping. It's amazing, but no, they're not. And I will use the rest of these charts to prove it to you. Just to use a more familiar index, just to give you an idea of what I'm going to tell you here, is that look at the Huey. The Huey is the gold bugs index that is only around since, I think, 1996. Yes, this goes back as far as this index has existed. So in the middle of 1996, this index was compiled. You can see there was an all-time high here of about 640 something in 2011, right around the time when the last gold bull market ended in dollar terms. And you can see here there was a nice little triangle. I like triangles. This triangle was broken in 2024. It was established in 2011 to 2024. It's a 13-year triangle. You can see there's a nice little support over here going up since 2016. This was the gold mining stocks bottom over here. And you can see we broke through that triangle with a vengeance.
With a vengeance!
And we're up to about 560 or so. But is this really a rally? Nope. Not even close. This is the same index, the Huey, the Gold Bugs Index, relative to the S&P 500. So you see here that this high indeed was an all-time high for the Huey Index in 2011 at the end of the last bull market. We hit about 0.56. It looks like in the ratio of Huey to S&P 500. So the higher this is, the more expensive gold mining stocks are relative to mainstream stocks, the S&P 500. We hit the low over here in 2001, which was when gold was about 254 or so at its 2001 February low. So this makes sense. You see here that there was a lot of volatility swinging in the gold mining index and the Huey. And look at this rally that we've been in since 2024. You could say 2025. You want to just count it over here. We're at now. Oh, look at this nice little thing. It's not even where we were in 2020, right? It's not even close. So look at this. This is the same rally relative to the S&P 500. So we see here that S&P 500 index investors would say, "Oh wow, look at your gold stocks. They're like so claiming. Oh my God, look at that huge yearly candle. It's the biggest ever." But like relative to just investing in the S&P 500 since 2015 when the gold bull market bottomed, yeah, this hasn't been much of a bull market at all yet. Nothing, not even close.
In today's precious metals news recap, silver steals spotlight, charging toward 50 while gold pauses. Precious metals remain firmly bid, but leadership has shifted. Gold's rally stalled just ahead of a key Fibonacci projection, while silver broke out to a new 14-year high. Both metals remain supported by a mix of geopolitical risk, policy divergences, and strategic investor demand for hard assets. Silver's case is probably more compelling. The market faces a prolonged supply deficit and tightening physical availability, giving its rally deeper structural foundations. This dynamic, coupled with strong investor interest, has pushed prices higher and opened room for further gains on both near-term and medium-term horizons. Near term, silver will remain bullish above former resistance at 39.49, now turned support. Next target is 61.8% projection of 28.28 to 39.49 from 36.93 at 43.85. Decisive break there could prompt upside acceleration to 100% projection at 48.14. Now smash the subscribe button and turn on notifications so you do not miss out our daily recaps, and go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
BGMI. So here we see the BGMI going back to 1935, 34, something like that. And this is the ratio of the S&P 500 versus the BGMI, the Barron Gold Mining Index, to see how this ratio has been behaving since then. So we see here, the higher this goes, this is the inverse of the other chart. This is the only chart I could find of the BGMI S&P 500 ratio on gold charts R Us. I couldn't find the inverse, which is what this chart is. So these charts are flipped. So here, the lower you go, the worse the gold stocks are performing. Here, the higher you go, the worse gold stocks are performing. So we see here, they were performing very, very badly in 2001, from about 1995 to 2001. Gold mining stocks capitulated. They fell. What's the other word? Crashed. Whatever you want to say. And then they went back up into 2011 over here, where the ratio was about 0.55, as we saw on the previous chart. So look at this. We see here that where we are now, we're at 4.83. Could be a little bit different right now. This is like a few days old. But you can see here, we're right near the all-time lows. The all-time lows were about 7.4, 7.5, something like that in 2015. We're not right at the lows. We're a little bit higher than the lows, yeah, but Yeah, nowhere near where we were throughout the 1940s, 1950s, 1960s, 1970s, 1980s until 1994, right? When gold stocks crashed and then rebuilt themselves and re-rallied into 2011, then crash and have been very undervalued ever since. But the question is, what is the high? Meaning, what is the low in this chart? It's hard to see here because it's too close to the bottom, but we can calculate it with individual data points. Not here, not here so much, but right here, 1980, and notice that the high in gold stocks was after the January 1980 spike in gold and silver. Here is a zoom in on the BGMI for 1980. This was the all-time high. It's about 1280, eyeballing it, first week of October 1980. So if you take that number, 1280 for the BGMI, the high, the all-time high in the BGMI in October 1980, 1280. Go to the next chart and you see October 1980, the first week of October 1980, we can eyeball it. It's about 132 for the S&P 500, 132 first week of October. So you take 132 divided into 1280. What do you get? You get 0.103. So we have the current number of the BGMI, which is 4.83. The all-time high in 1980 of gold stocks versus the S&P 500 was 0.103. You take 4.83 divided into 0.103 and you get 47. 47, which means the value of gold stock is going to have to rise 47 times relative to the S&P 500. And you're asking me, well, is the S&P 500 going to stay the same? Is it going to rise? Is it going to fall? It doesn't make a difference. The point of this ratio is to say that the purchasing power that is currently in the S&P 500, all the dollars that it's worth, and if you were to liquidate it today and get that number that you see on your brokerage account number, dollar number, and you're able to buy all the stuff with all those dollars, all of that purchasing power will be sucked into gold mining stocks at a rate of about 47 times. So the purchasing power of the S&P 500 is going to fall 47 times, and the purchasing power of the BGMI, of the general gold stock environment portfolio, whatever, is going to rise about 47 times.
What do you think of Salente's take? Will gold continue to rise in the fourth quarter of 2025 and beyond? Are we approaching a major top in the global markets? Post in the comment section down below your honest opinion. Subscribe if you have not yet done so. And check this video right here because it's a perfect fit for you, and I'll see you on the other side. Thanks for watching.